Thanks, Zorafur.
Hi, morning.
I'll hand over to you now.
Wonderful. All right, thanks so much. Thanks so much. I see some of our esteemed panelists joining. Godfrey, good day to you. Anthony, I see, is joining as well. Anthony, can you hear from my end here? Godfrey, can you hear me from my end?
Sure, clearly.
Yeah, I can hear you. You can hear me, Zorafur?
We can hear you, though we cannot see your picture, but we can hear you, Anthony.
Oh, you cannot see my picture. Sorry.
I know we have one more panelist joining us shortly, Caroline, and I believe Chris Chege is on the line. We're just having him join as well.
Zorafur, can you see me now? Video.
Not yet. We can hear your voice, but we can't see your video yet.
I can see him though.
Yeah.
You can see him. Okay, perhaps it's on my side.
we can see you also. I can see you. Yeah. I can see you now. Yeah.
Okay, wonderful. So great. It's good to be here, everyone. I think we will be having our additional panelists join us momentarily. We're excited to be talking about the debt markets today, and we've seen some fairly unprecedented times. And what we wanted to talk about is the implication of COVID on the lending environment and the affordable housing environment and sector. And in addition, thinking about where we might go post-COVID and what types of products and solutions are going to help unlock the affordable housing sector in Kenya. And today we have an esteemed panel. We have Mr. Godfrey Tepela from the IFC, focused on investments in affordable housing and property in general. We have Anthony Kambiri from Mavida, who is the CFO of Mavida, a large real estate, affordable housing and housing developer in Kenya. We will also be joined by Caroline and Chris Chege, who join us from the banking sector. Both are heads of the mortgage departments at their respective banks. It looks like we have Chris joining the conversation. Chris, welcome to the conversation today.
Thank you.
How are you doing?
Thank you. Very fine.
Thank you. And I was just doing introductions. And Caroline, Chris is the head of mortgages at the Cooperative Bank, and Caroline is the head of mortgages at KCB Bank. So we're very well represented. Thank you all for joining us today. Thank you, panelists, for being here. I'll just ask each of you, and I'll sort of do it in the order I see you on my screen here, is to maybe just to do a quick introduction and share some initial thoughts on what we're seeing in the debt market related to COVID, and what's happening in the environment right now with COVID, your reflections on COVID, and also the implications might be on the debt market. Godfrey, I'm going to start with you. You're the first. I see Anthony next, and then Chris. So I'll just kind of move in that order, and I'll just start with you, Godfrey.
Thanks, Zorafur. Very pleased to be part of the panel. I think, we are in facing unprecedented times, and I think we tend to, in the different environments that we are in, we take projects to our credit committees, and there are questions around how much sensitivity we've applied on them, and we never get to a situation where you forecast a situation where there's zero revenues. So, COVID has certainly brought that to the fore. That said, I focus on the real estate market, including tourism, affordable housing, commercial property, and also retail across East Africa, based in Nairobi. And what we're seeing is definitely, I think, what COVID has done is it's brought a number of projects to a halt, or they've ground to a halt, largely because of the uncertainty that has been created on both the supply and the demand side. So as IFC, I think what we've done globally is focused on trying to assist our existing clients with working capital facilities. I think there was a facility of about 8 billion that was put aside to deploy very quickly to existing clients across the globe, across various sectors. And these are mainly working capital facilities to clients in different sectors, including banks, who are obviously part of our clientele. And that's really to sustain businesses, or save jobs through the period of COVID, which obviously I think timelines are debatable in terms of when we will see the end of this. And then, I mean, what it brings to the fore as well, I think the government has been forced to step in a number of areas, given the discussion we had on the economy at the beginning, making them divert funds that were meant for certain programs into COVID programs, which obviously puts a fiscal strain on the government. And but the whole genesis is to try and save jobs. But post that, I guess when there is recovery back to pre-COVID times, we begin to see maybe some level of restructuring of the sectors, and also over time back to business. But each sector will be different in terms of how it reacts. But in essence, I think we remain active in terms of providing debt and other instruments to our clients. I think it's much more pronounced now. That's why I said, IFC came up with a program to deploy very quickly working capital facilities into the economies or into the sectors that we play in. I'll leave it at that for now. You're muted.
So, sorry
about that. Yeah, sorry about that. So, Godfrey, thank you so much for that input, and really great to hear about the proactive response by the IFC. I'm going to hand it over to the next panelist, Anthony, to share the same. I'll just ask our other panelists to please keep muted during the time, and then we won't have any feedback on the mic. Anthony, it'd be great to hear your perspective on from a developer and for someone active in the market. What are the implications of COVID, and how are you seeing things?
Thank you, Zora, for this, and just to sort of give a background about MIVIDA. I wear two hats. I'm a CFO of MIVIDA, but also with the Garden City Precinct. So I have a view across both retail, commercial, and the residential market, because we sort of play in all those three segments. And COVID has brought us to very interesting times. I think that the word that has been largely used a lot is unprecedented. And especially when you think about debt from a developer's perspective, this is a bit of a difficult time to sort of be looking at taking facilities. But we have a couple of ongoing discussions, and we have long-term relationships with banks, and I think one of the things is that we can see some of the local banks sort of taking a more long-term view of this, but definitely a lot of more stringent sort of due diligence, a lot of more interrogating of the business plan, to sort of just really understand how things are. And I think that's one of our perspective. But one of the interesting things, and I think COVID brings about is when you think about especially the residential market, it had a bit of a strain even before COVID. especially given in Kenya after the interest rate capping, a lot of projects, in terms of getting project finance, became quite difficult, for a lot of projects. And now, given COVID, that puts a lot of projects under, your non-performing category, in terms of there's a lot of restructuring that's sort of happening here. And going forward from COVID, I think, very few, developers, will really stay in shape. And my view, and I think, across the board would be, more of your institutional type developers are able to, who have a good track record, who are willing to put a bit more equity into the projects, are going to have a better play, because, there will be a lot of flight from a residential perspective, from your smaller developers to more of your larger developers, because, they have a bit of more backbone and can be able to attract, project finance easily. They're able to sort of go, need depth in terms of, putting in equity into the project, and from a project finance. So that's one of the things I see. I also see, sort of, banks and everyone becoming a bit more innovative in terms of how they view things. And because, we still have a huge housing demand, whether be it, from a residential perspective or the like. But definitely there are a lot of conversations happening, across board, on how to sort of share the pain between, landlords and tenants, and also, and also the bank who have supported these developments, to sort of just ease it. And we see going forward, that sort of, better collaborative approach, because, it's a sector that needs to be supported. Thank you, Zurafa. I think that's my initial comments. Yeah.
Excellent. Thank you so much, Anthony. I appreciate that, and appreciate the thoughts on banks being innovative, and that there still is a unmet demand for housing. So there's certainly a need. And I like that term that you mentioned, share the pain. So I think we might come back to some bank innovation and these ideas of pent-up demand later in the panel. Let me hand it over to Chris. Chris, please, thanks for joining us again. Please share maybe a bit of an introduction and some initial thoughts on how COVID might impact the debt sector.
Thank you very much, and thank you, Zalva, and thank you, the fellow panelists. I think what has come to be is that there is a little bit of what we can call disruption, and the market has been disrupted, especially in terms of some of the areas that are not settled. I think if you look at the market in Kenya, we are maybe going through a transition when you're trying to stabilize the real estate sector, and especially trying to shift from the high-end developments and going into the low-end developments that are targeting the mass market. Of course, what it means is that that sector, the data is not there, much of the information is not there, but the need is there. So even the few that were working in that direction were working purely on faith that they can get a lot of support, they can get off-take guarantee, they can get those kind of things. So it was a new market that we were exploring as a country, as a world. Now, with COVID coming in, I think one thing it has done now is sent quite a number of the projects back to the board to try and understand what are the new risks that have come through and how do we tackle them. And then the risks needed to be analyzed both from a supply end and a demand end. Essentially, most people are comfortable if the demand was anchored and had the ability to offtake. And of course, a number of institutions that come to support that. The supply end historically in the country, I think the capacity is there, although not for the massive projects, but was ready to take a leap. Now, coming in now, I think the key things are, will the market stay the same? Are we going to have proper infrastructure and systems to support that? What does the social distancing mean to the new day housing? Coming now on the other front in terms of the reaction by the financial sector, maybe my comment will be that just like everybody else, we went in straight to try and understand our customers better, try and understand how their sectors have been affected and precisely how we can work together. It's gone quite well, and I think we can also thank the government who came in firsthand to try and cushion the financial sector. And I think the key thing now is seeing how things are unfolding. Of course, if you look through, the various markets have taken various hits. I think any retail without food anchor, I think they have suffered greatly. Residential, I think, is a push and pull. Logistics, I think it is their time that is coming through. So I guess there are so many things that are playing out. I think we are yet to see the whole thing evolve and settle. So I think ours is to study each day, every day, to see how things unfold. Thank you very much.
Excellent, Chris. Thank you so much for that. That was very helpful. You know, a few things that that you touched on, I thought that were noteworthy. One is, you know, the changing dynamic or the evolving dynamic of the sector heading into COVID. The affordable housing sector in Kenya is still very much in design, development, and gaining momentum. And we were sort of hit with COVID, and now that sort of adds a little bit more unpredictability to a sector that was still in its early days. So that's noteworthy. And Chris, really appreciate the fact that Cooperative Bank is working closely with its customers to design solutions. I think we'll come back to some of that innovation, hopefully a little bit in the panel. And lastly, I was happy to hear that you mentioned social distancing. You know, it's true that there's going to be some changing social norms that are coming about, and some of that you know, might be seen in the real estate sector and in housing, and you know, I'll just pick up there a little bit. I mean, this is something that is you know, a little bit understanding where we might find ourselves within this crisis. You know, we've been seeing news of sort of a rebound. We've been seeing the numbers increasing, and we're starting to see maybe the implications on the economy. And you know, just to maybe it'd be good to get one more reflection on COVID before we transition a bit more into debt for affordable housing. You know, we'll kind of go in that same sequence again. You know, starting off with the idea that where are we in the cycle? Where are we in the cycle? And you know, where do you think now we're going to see some of the institutions going? Are we going to get some more innovation? Do you think we're still going to be seeing through the crisis? It's a bit more of a wait and see, or are you starting to feel some activity is picking up and people are moving forward despite some of the uncertainties? Godfrey, I'll hand that one to you, and then Anthony and Chris in that order.
Sure. I think, I mean, it's still early days, I would say. I mean, certainly, I mean, if I was to pick a specific sector, if you look at tourism, you know, we heard that flights are going to be opening soon in Kenya, and it's peak season in terms of, you know, the safari circuit here. There are a couple of things to look at in terms of, you know, there is one thing opening up the international flights, but it's another thing convincing the tourist or the traveler to get on a plane and you know, and get into the norm of the tourism cycles that we know. So I think it's going to, there's a behavioral change in terms of, you know, I think some hesitancy in terms of just jumping into the pool. Hence, we will see, I think, over time, some recovery, but I don't see that as being immediate, because I think in the tourism sector specifically, it's the impact on flights, and then it's the impact on the hotels. So, I mean, there are two elements there. So, I would say, you know, for hotels, possibly, you know, a year, 18 months, but I mean, that's just my gut feel. But with the opening up of travel, I hope, you know, that there will definitely be some activity. And those countries that rely or are developed in terms of domestic tourism, I think will tend to absorb that better. In terms of housing, I think COVID has come to emphasize the importance of affordable housing. So affordability is going to be much more pronounced going forward in terms of, how do we creatively come up with products that ensure that, activity continues in this space. So I would say, I think in terms of COVID, the impact is unpredictable, but we are hopeful in terms of, what governments are doing in terms of opening up economies, because that is what will trigger activity going forward.
Excellent. Thanks so much, Godfrey. I just want to highlight one thing that you said there, actually, is around the resilience or the underscoring of the importance of housing, affordable housing, and sort of the multifamily sector and real estate. We saw in many markets that were supported by government through cash transfers that multifamily fared very well globally during this time. And I think, as Godfrey, you pointing out, there's this underscored importance or this renewed importance on homes, on safe and clean homes, on dignified homes, on quality homes, because it's projected that part of our day-to-day operations might end up moving home. And this is a bit more for white-collar workers, where we might see more video conferences and events like this. And but we also realize that the bulk of the economy operates within sort of the blue-collar workforce. If you think about manufacturing and maybe even the service industry, and so some of the maybe some of the implications might end up coming on design of affordable housing, but and design of common spaces and design of or services around cleanliness and sterilization. And so, interesting times ahead, and that's some of that is yet to be seen. And thanks for that feedback, Godfrey. Anthony, just hand it over to you, and get your thoughts as a developer. Are you thinking? Is it still wait and see? Are you still kind of working through the project life cycle? Have you been as active, and what sort of timeline do you see coming out of COVID?
Hey, thanks, Rafa, for that.
I'm not sure. Oh, there we go.
Yeah. Sorry. In terms of COVID, I think it's fairly unpredictable because there could be another second wave. And how do you sort of work around it? But one of the things is that there are a couple of impacts. One of it is on live projects which are already under construction. So we are having to see, a sort of a different way of working around projects, maintaining social distancing. If you're on a construction site, how do you sort of, enhance testing? What happens, in terms of your SOPs? When you have a COVID case, how do you test? How do you mitigate? Do you have different teams? Sort of a team 1, team 2 working on a site and rotating, so there's a different sort of working methodology on a live project. But in terms of going forward, I think I see some cultural change in terms of how people are working. So that will affect both, commercial space and the view around that, and then also the residential space. I think people having stayed at home for a long period of time, you can hear a lot of people saying that, you actually need to have, a workable space, on a residential setup. A lot of people don't have, a sort of a mini office or a space where you can actually work in a house setup. So that will mean that, we'll need to sort of, from a design perspective, begin thinking, how do you create flexibility? How do you sort of, have an office sort of integrated, within a design or even in a common area, having a setup where people can work in. So I see that sort of cultural change that sort of affects design, sort of affects, how people think about. Then I also see some change in terms of, especially during this time when a lot of people have been spending time home, in terms of the need to own a home. because a lot of people who've been affected, especially with job cuts, and from a landlord-tenant perspective, you can see a lot of pain being felt on that perspective, with concessions being asked for. That will mean that a lot of priority will go back towards owning a home, and I think that will spike demand in the future, because people understand during this time how important it is to actually own a home. So I see some of those changes sort of coming across in terms of the impact of COVID. As to where we are in the cycle, not sure, because I think we can see cases like in Kenya are going up. As to when that will sort of topple and begin coming back, no one is very sure. But one of the things is that we've also seen people sort of accepting that COVID will be here with us for a while, and sort of trying to put in mitigation measures to sort of work through it, so that the economy doesn't shut down, businesses don't shut down. But the resilience is put to work with a disease that will be here with us for a while. So I see that sort of being the sort of working mechanism in terms of how people are sort of viewing it, and how to sort of navigate through it. So everyone, even from a debt perspective, from our financial partners, everyone is coming together to sort of see how to navigate it, because the end is not very clear on when it will be, and we need to get there together. Thank you. Yeah.
Excellent, Anthony. Thank you so much. That was really, really helpful to hear. Really appreciated your perspective from a developer's standpoint, because you're thinking about the customer in mind, the retail customer, the home user and homeowner. And, really appreciated your reflections on how we might see some changes in the spaces and the designs. Maybe they're more shared working spaces within sort of amenity spaces. And also the changing behaviors of households, thinking about maybe ownership, thinking about maybe that having that office or having a space they do their Zoom calls with their family. And so that's really helpful to hear. And then lastly, this concept of living with COVID, it's something that it seems like is being now incorporated into growth strategies and design of business, maybe risk management policies, whatever it is. It seems that the way that we're trying to manage COVID is to incorporate it within our practices, and I think it remains to be seen if that will become more cumbersome, or if it'll be more creative or more oriented to do new solutions that we haven't seen before. It seems like we're very much within the design of that at this moment. So that's helpful to hear, Anthony. So thank you so much for that. Chris, just over to you. From the bank's perspective, where do you see us in this COVID cycle that we seem to be going through? Are we, is it still a bit unpredictable? Does it seem like now that we're opening up, we might see an activation of the industry again? And I think around Godfrey's point around tourism, thinking about sector impacts, is there some sectors we might see uptake earlier? For example, can housing be looked at as a sector to help drive recovery coming out of COVID? So maybe any just reflections on sort of where we might find ourselves and sort of what we might see coming out.
Thank you very much, and thank you for my colleagues and very insightful thoughts that they've shared. I think my take here is that right now what's preoccupying everybody's mind now is safety, is to ensure that your customer is safe, your staff is safe, and generally that you can be able to go through the whole pandemic and still be there. And but shortly after, of course, you have to look at the other angle in terms of especially how do you make it after that. I see an aspect, especially in our area, that is real estate. I think there will be a rebalancing because I think if you look at the approach we had adopted there before, it assumed that you can be comfortable when a neighbor is not comfortable, which does not work. We have to agree that they are the minimum acceptable standard for you to say you have a sustainable sustainable setup. So I think now what it calls more now is that when analyzing maybe from a part of a bank perspective or a risk perspective, then you have to look through whether the project is sustainable given the environment, and not a short term. With this new experience, we've learned about things like home office. Let's put across. Is that something that is very critical? And if it's critical, is it being availed? Where does it rank in terms of trying to evaluate a risk of a case, of a project, of a customer proposal? I think the other thing that comes in and the direction now is the affordable. I think when you look at the affordable, the approach for affordable before this was that it should be available maybe in the periphery. And we had only seen the expansion areas like now, if you say Nairobi, for example. The question is, do those areas have the support systems for that? Are we going to open up a site using a hospital or a mall? I mean, what comes in first? Is it health or is it the retail space? And with these kind of considerations, then what gives in? Because something must give in because the numbers must work. Otherwise, when you open a project with a social infrastructure project, it puts pressure on the profitability, the bottom line. So the main question here is that what will give in? What does the people give in? And to that's where we see maybe a conclusion that space management becomes very critical going forward. And I don't think anybody will be interested in idle space in where they are. And I think when it comes to acquisition of space, whether it's space for rental, space for house or whatever, then you will see how that space literally relates to what are the basic amenities. Is there a clinic that is available? Do we have a school that is available? What is the kind of school that is available in interlinks? Now, with all this, of course, it means then that going forward, the risk parameters as defined before COVID are slightly going to change. And of course, it takes some time before everybody agrees that this is the standard. And I'm sure, and also Godfrey can share, that we will have to redefine afresh and see how kind of models are going to work for any form of financing or consideration post-COVID. Thank you.
Excellent. Thank you so much, Chris. Really, really great feedback. I want to underscore your comment around safety. COVID was a health pandemic first and foremost before it became an economic implication. And many people were impacted, adversely, loss of life, and everybody's challenges go out to those families that were impacted and affected. And the thinking of how to now incorporate those safety standards into our day-to-day life, whether it be sanitization, whether it be social distancing, whether they are the amenities also in the homes that we're looking at. Chris, you highlighted a good point in that a lot of it is now being considered, being thought about more deeply in a new way that we hadn't really thought about before. So, that's some very valuable feedback. I think we'll try to now shift the conversation. We wanted to start off with understanding implications of COVID and hearing from three different actors within the supply chain. That was extremely helpful to hear. If I was to sort of summarize, it seems like that we're still very much within COVID, and we're seeing sort of a new phase of it with the opening up of the economy. And so this might be a opening up and a pathway back to normality, or it might be an opening up and we're not sure if it then slows down again. So this is something that's a bit TBD, but what is certain is a lot of people are examining their business practices, their risk management practices, the implications on the business of lending or the implication of the business of building homes and providing homes. And so it's certain that COVID is leaving a lasting impact on all of us and our sector. So thanks for all of that feedback, panelists. Let's shift gears a little bit and come back to this concept of debt for affordable housing. And, this debt finance can really be thought of almost in two ways, actually. We could be thinking about it from a project development and construction perspective, and thinking about it from a household perspective of of mortgages and offtake. And I'm hoping to really just start the conversation there and come back to Anthony, as a developer, as a builder, as someone that's interacting on a regular basis with the market. What is it that, and you can do this in sort of a pre-COVID sense, if you will, even, or sort of trying to incorporate what we're learning in COVID with this. But, what types of financial products and purchasing power and capabilities are you finding with the Kenyan consumer? What are the implications on things like duration of loan, of interest payments, of down payments? What have you been seeing that customers are amenable to? Are they interested in mortgages? Are they looking at more buying units with cash? And then do you anticipate that we might see also a trend towards rental as well? Just sort of share a bit of what you think we might see from the customer side in terms of accessing those homes. What kind of products, financial products, they may not exist right now. You can share maybe what some of the work you're doing. But if you were to sort of think a little bit about the target customer, what type of financial product would be amenable to them to access a home? Anthony, I'm handing that over to you, please.
Okay. Thank you, Zaraf, and thank you everyone else. And when I think about sort of what sort of financial mortgage products that are available or should be made available to the customer, because we interact on the customer on a day-to-day basis, I think one of it, and so you have to look at what are their pain points. The biggest one being that the initial deposit, especially for a homeowner, is usually a difficult one to sort of raise, and how do you sort of cure this? Then the second one is the fact that a lot of times for someone who's seeking financing, especially for a mortgage type sort of product, usually comes in at the end of the project. So they usually are not able to come in at the beginning of the project, because one of the challenges is that for the securitization of the mortgage, you require to have an already built product, and at that point in time, the price is already on the higher side in that case. So you have sort of those two pain points, and then the third one being that how do you sort of there's a question around affordability, with double-digit sort of interest rates, the interest rates being variable, and when you look at other markets, you sort of have fixed interest rates, and a lot of things, and affordability can be looked at in two ways. It can be looked at in terms of the tenor, such that it might be expensive, but your monthly repayment is affordable, even if the interest rate is high. And it can be looked at in the other sense that if you're able to sort of come to single digit sort of interest rates from that sense. So one of the interesting ways we've seen sort of the market pre-COVID sort of dealing with this is to look at some of your more relatable markets, and one of it is like India, where you have sort of a construction-linked sort of mortgage type product. Definitely, that is supported by a more advanced sort of regulated development or real estate sector. You have a strong legal framework that looks at how do you sort of securitize a mortgage even before the unit is built in that way. But this sort of product and I think I would encourage where banks would come, because one of the biggest challenge being on the developer side is that you want to take project finance, but you also want to sort of gain a lot of comfort on offtake, and you have a lot of people who have demand, but they would like to come in early on in the project to take advantage of cheaper prices at that point in time, and that sort of construction-linked mortgage, where actually, and we are doing this with one of our local banking partners, where the customer will come in earlier on in the stage, and they'll partner with the bank, and the bank will sort of pay through sort of milestones into the project on the account of the customer. And the customer at that point in time maybe just servicing the interest at that point in time. And then when the project is fully done, then this converts into a sort of a mortgage product. And this can happen, with your larger developers who have a good track record, who are well backed, and it's easier when the bank is sort of providing both project and offtake financing in that case. But I think another one that has been in discussions even with the government is sort of pension-backed mortgage plans, where pensioners are allowed to access a portion of their pension. I think the government of Kenya is sort of thinking about 40% in the draft regulations, which have not yet been gazetted, to sort of be able to use that to fund the initial pain point, which is the initial deposit, or to sort of even fund a portion of what it is. And then the government can sort of come back and say, we'll give a partial guarantee on a portion of the loan to sort of just enhance that affordability and access to mortgage. Because I think, it's not just affordability, there's also the issue of access in that case. So I think those are two interesting sort of plans that I think would work for a customer, especially when you're focusing on homeowners. Because if you go to and read the statistics, especially in Kenya, of the people in Nairobi who own their own homes, they are less than 10%. The people who own their own homes, a lot of people in Nairobi actually rent, majority. But even if they rent, that is funded by someone in that case. So it's just sort of trying to move that balance from not people just renting, but people being able to own a home, whether it's especially in the affordable segment. Thank you, Zorafaya.
Excellent. Thanks so much, Anthony. Really appreciate that. I think you touched on so many really good points, and I'm going to try to incorporate those into the questions as we pass it forward here now. Chris, just picking up off of what Anthony was saying in terms of the types of financial products that could be helpful for developers, there's this concept of sort of construction linked, where there is a component of construction finance, component of housing finance, and somehow the two of them are interconnected. It would be great to hear about whether something like that, or if there's other products that are in design or that have been developed that could be amenable to accessing homes for customers. And then maybe even touching on this concept of a guarantee, partial guarantee, if something like that would be helpful from a portfolio perspective at the bank. What is it that can help provide some form of risk cover as we look to create the right products that get homeowners their homes? And I'll just say this, I noticed that we have about 10 minutes left in our panel, so I'll try to sort of like speed up some of the questions and just ask my fellow panelists to help me there as well. All right, Chris, over to you, please.
Thank you very much, and a couple of very nice points that have come through there. Maybe is to assure that there are enough financial products in this market to cater any kind of finance, whether it's end finance or project finance. I think the biggest challenge that has come through is the structure, the kind of structures that are adapted on the project. Most of the projects, I think, have approached that maybe the most important part of a project is financing, maybe which at times is not. And I think I like what Anthony has put across. I think one of the most important things, is ensuring exit is there. So what most of us are looking at right now is demand-driven projects. That is, you must see where the demand is. Once you've seen the demand, then tying up such a project becomes very easy. And if I reflect on what Anthony is putting across, tying project finance to end finance, that is all end mortgage finance by installment, as we call it. That is, you are tied to a project, but you pay in installments. I think the main advantage here is that it de-risks the project. But I think the issue that comes at hand is the whole area around pre-sales. because pre-sales are not treated as a way of financing. And when you look at most of the projects, the expectation of what we call pre-sales is not at times realistic. Now, what happens now, it becomes a push and pull factor between the developer and the financing entity. In which case, the developer will put in numbers that when you look at them, they are not sustainable. The end result now in such kind of project is that you'll find variations that are driven by delays on site. And I guess that's now where the main issue comes in. And that's why you'll find most people are comfortable when you separate the two, where you have project finance, handle it separately. And once the product is done, I'll come here and I'll handle the end finance. But said and done, there is room for de-risking that roadmap. And I think that's what you're putting across. And I'm sure Godfrey will also mention on this. I think these are where the guarantees, and I know there's been this talk of off-take guarantee, and what does an off-take guarantee means. But besides maybe from in a project level, is just being able to utilize the trade instruments to be able to de-risk. Most of the projects you find that when they get cash array in the project, they tend to do some of the things that also burden the project from an interest perspective. So what we encourage here is that, can you have maybe trade instruments? Can you have an interavailable line? Can you have a line whereby if you are doing an FX, can you be able to have it at hand so that you don't have to suffer those kind of costs? In so doing, can you be able to have a hedging mechanism, especially if today you send a letter of credit to whoever who is supplying you the tiles and whichever, other materials, and on time, you reduce the interest cost, which is higher between now. With this kind of innovation, then it helps, especially in the delivery of the project. But when you come now to the exit, the exit of the project, I think the key thing is identifying who the buyers are. And in most cases, we are able to tie them across within one entity. It is very easy for you as a developer to be able now to request that you start utilizing, because if the buyer is there and you're talking about documentation, I think that's something that can be locally managed. And we've seen some of the entities like SACCOs doing very well in that. Most of the SACCOs do not go through the registration process. And that's why you see they are a bigger house giver than maybe the what we will call the standard entities. So I think there's a lot of innovation in the market. And I think what we look is the structure and adapting into what we call the formal segment of the market for us to move forward. So I don't think we are short of what we'll call very innovative financial structures and model to take care of what is being put across. The product actually is called End Finance by Installment. It's available across board, or buy, plot, and build, which is the same. And depending on how you have looked at the project, those are things that are doable. I'm sure Godfrey will have a comment on this.
Absolutely. Chris, and actually, Godfrey in a moment for our final question for the panel today. I just want to sort of set the stage for the handoff to Godfrey. Chris, you mentioned something interesting around the quality of the developer and the certainty that the units are going to come to the market. I think we've seen in our market in Kenya and other markets around the world, when we start having a growth in real estate like we saw over the last 10, 15 years, you see that there are some developers who are pre-selling, using some of those pre-sales as a part of construction finance, but maybe not maintaining a cost structure or tight cost structure, and projects may not be delivered, and so therefore that leaves sort of a gap in confidence in the market, both with the customer, but then also with the financial institutions. And so, in that regard, maybe some concepts about bringing the bank and the developer a little bit closer together through conversations, product innovation, standardizations could be interesting, and then supporting some of that with risk cover. So, just some ideas that, Chris, that you'd referenced, and I'll hand over to Godfrey just to help us kind of wrap up the thoughts here around what sort of facilities could be helpful, and then maybe have close for us.
Sure. Thanks for the initial thoughts from Anthony and Chris. I think this is housing is a no-brainer I mean, as a business, I would say, because supply can never catch up with demand. But the downside is that there's several layers of risk which unfortunately have to be looked at, and that's why I think globally housing remains a challenge or a crisis. So there needs to be a methodical way of cracking the nut, and I think Chris and Anthony alluded to a number of these aspects. It is important to have a developer that has got a track record, that has done it before. You want to avoid speculative projects. Build, they will come. The developer has to have the right management. I mean, typically the fundamentals, when you come from the macro down, are there. I mean, like I said, the supply demand equation is out of sync. So it is when you get to the micro level that you really need to button down the project to ensure that it is sustainable. So I think pre-sales are important as a market test, but I mean, we need to ensure that there's no over-reliance on them as an equity injection by the developer. They don't absolve the developer from not putting enough equity to make a project bankable. I think we've seen it with COVID, as I mentioned earlier, that the sensitivities that we are now talking about can be up to 100%, drop in a particular variable. So it is important that there is enough cash equity in the project. The land is not overvalued. There is an understanding of the market study that gets done in terms of affordability, incomes, etc. And as IFC are typically, we are multi-sectored, but we realize the importance of ensuring that supply and demand work hand in hand or in sync. Because I mean, I think typical of the past, maybe from a supply side, I would focus on supporting a developer without really taking into account that there needs to be an offtake. So we are working much more closely, internally, in terms of what we deliver on the financial market side, in terms of supporting banks, and what we deliver on the developer side in terms of funding for developers. So my colleague Habib is probably not attending the conference, but Chris would know in our interactions that we always working or talking together. And what we see as well is I think the opportunities, we provide credit lines to banks for the offtake, but we also open to de-risk banks in terms of what we call RSFs or risk sharing facilities, where we take an element of risk and share with the bank on a portfolio basis. But we obviously need to have some criteria of what qualifying products you would have there. But just a thought as well, I mean, this is given my experience in terms of the first house that I bought or apartment that I bought, is maybe providing an insurance product to first-time home buyers that gives the bank the comfort that, should the buyer default, they can actually fall back on that insurance product. I don't know whether that is something that has really been deployed in this market, but also the aspect of the TPS schemes. I think those are things that need to be pursued, so that we're looking at multiple solutions. So I think that's my take.
Excellent. Thank you so much, Godfrey. That's very helpful in thinking about the product design conversation. Really great to hear that the institutions like the IFCs are having conversations with banks like Cooperative Bank on a regular basis. Let me take this opportunity to thank each of the panelists today. I think we tried to take a holistic approach in terms of a value chain approach to financing, from builder to bank to supplier of capital and DFI in this case, and it was very helpful to hear from all three perspectives. So thank you very much to our panelists today. A big thank you to the the next panel, because I know we ran over a little bit. So thank you to Kavir and API for our patience there, and for